What's going on, everybody? It's going to be a quick video covering my 8 and 24 EMA strategy that I talk about pretty often on our live stream. In this video, I'm going to talk about why I chose the 8 and 24 and why do I call them the aggressive and responsive trader lines, right? We're going to talk about what to look for and how to trade them as well. So starting off, why did I choose the 8 and 24? So really with moving averages, as you guys have probably seen at this point, they are pretty much personal preference. For the most part in trading, everybody has a number they like to use. I used to use like the 8, the 9, the 10, the 12. You just kind of play around with it until you find one that you like. And the 8 kind of stuck with me. And back when I was using moving averages quite often, I liked using 3 moving averages at a time, kind of using a fan. So I would use the 8, the 16, and the 24. And I would call the 8 EMA the aggressive line and the 24 the responsive line. And what I mean by that is if you look at how the 8 EMA, by the way, the blue line on my chart is the 8 EMA, the orange line on my chart is the 24 EMA. If you look at how price responds to the 8 EMA, typically it is going to be when there's a very aggressive trend in one direction, when price is just continuously breaking highs or continuously breaking lows. Every time it pulls back to that teal line, that 8 EMA, it bounces off of it. It refuses to break that level when it's in a very strong trend. Now, if the trend is a little bit weaker, like this trend right here, and you pull back and you continuously break that 8 EMA, then typically it will pull back into that 24 EMA and it will fail to break that level. So that trend is still moving in that direction. It is still a downtrend in this case, but it's not an exceptional, it's not an exceptionally aggressive bearish trend. It's actually a little bit more responsive. They're allowing those pullback traders to do most of the work. The aggressive traders are kind of getting trapped a little bit. When you start to break those lows, those traders are actually getting stuck on those lows, allowing price to pull back and hit that 24, and then the traders are coming in and starting to push it back down. So when you see those markets that are just extremely aggressive in one direction, you feel like you just can't get a trade. You're just watching price run away without you. That is typically when that 8 EMA is just pushing price higher or pushing price lower, and they're failing to stay above or below that 8 EMA to break that trend. And then in those trends where you feel like, man, I'm trading the breakouts, but I just keep getting trapped. These breakouts just keep failing, but it's still going in that direction. How am I losing this trade? That is usually when the 24 EMA, the responsive traders, are in control. Okay, so aggressive and responsive, basically just think of it as aggressive are the market traders, the traders who are really pushing the price. They don't want to wait for price to come back to them. They just want to see price move in that direction as quickly as possible. The responsive traders, those are the traders who are a little bit more patient. Those are the traders who like to use limit orders. They like to trade the pullbacks. They don't like trading the breakdowns or the breakups of these major levels. They like waiting for price to pull back maybe to an important level, maybe to VWAP, a value level, a daily high, something like that. That's usually when you see those responsive traders protecting the 24 EMA. Okay, so that's the general idea of why I use these levels. Let's take a look at how to actually read it on a chart and how do we trade that on a chart as well. If you guys enjoy this content, make sure that subscribe button, make sure to like the video, and let's get started here. So looking at the overall trend, let me start off by saying I am not a very big moving average trader in the sense that I do not like taking entries just solely because of moving averages. I like to use them as confluence. I like to let them help my trade. I don't like taking trades just because the moving average, maybe a crossover, or it's failing the 8 or it's failing the 24. That's not my style of trading. I like to use them more as support, supporting my other entries and trailing. to help close my other entries. So looking at it here, you can see on this trend, the one that we talked about earlier, this would be what I consider a responsive trend. You can see how price is breaking lows. They are putting in new lows. But if you look at this and you say, okay, I'm going to trade this as a breakout, you would have probably lost that trade. Same thing here. I'm going to trade that as a breakout. You probably would have lost. Same thing there. Same thing there. So yes, we are trending lower. But if you are trading this as a breakout to the downside, you are most likely losing these trades. Yes, you have the idea of where the trend is going, but you don't understand who's in control. It is very important to understand whether the aggressive traders are in control or the responsive traders are in control. And on this example, the responsive traders would be in control, those pullback traders, because they are allowing price to break that ADMA, the teal line, and they are allowing price to come back into that 24 EMA. Okay, so when you see stuff like this, where you see those breakdowns failing, and price is pulling back into that 24 EMA, we want to be focusing on trading pullbacks. We do not want to be focusing on trading breakouts, those breakdowns of the lows. Okay, now in a trend like this one, you can see this trend is much more aggressive. Yes, it does have a few times where it breaks below that ADMA and pulls back into that 24, but the vast majority of this trend is staying above that ADMA. So when you see stuff like that, you are usually very safe to buy those breakouts, and you can kind of use that 24 as your trail. You can use that as your trailing stop loss, right? So as long as you're seeing those market structure breaks, those 5-minute high breaks, those 15-minute highs, 30-minute highs, whatever you like to use, you can see on the 1 minute, by the way, we like to watch these on the 1 minute and the 5 minute. They can be used on other time frames, but typically when we are scalping futures, we like to watch these on the 1, the 5, and the 30. Okay. So on the 1 minute, when we see new highs being broken continuously, and that ADMA is protecting the vast majority of the lows. Yes, you have some breaks of the ADMA to the downside, just barely a few of them. But the vast majority of the candles are being protected. Typically in that scenario, we are safe to buy the breakouts, a lot safer than we were on something like that. Okay. So if you see something like that where you're breaking the highs and you are pulling back to the 24 every now and then, just understand that your trail should probably be below the 24. Okay, so if we are longing and holding on to this trend, we want to be trailing that 24. Let's look at a few other examples here. So here is a good example of what it would look like when the trend is shifting and it's very aggressive. So we have this trend. It was started out very aggressive for the buyers. Then we started getting very aggressive for the sellers. So let me turn off the moving averages really quick, just so you can see how the price action looks. Like obviously when we look at the price action, we know that is extremely aggressive. And then when we throw on the moving averages here, we have that confirmation that it's very aggressive. These candles are continuously breaking the lows and staying below that ADMA, okay? Now on the bottom here, it starts to get a little bit extended. You see how this candle structure here, these lows right here, are very far from that ADMA. Let me replay this. I'll show you exactly how far they are. So look at that ADMA. That ADMA is all the way back at 69. It's currently trading at 61. So in a 1 minute time frame, on a scalping time frame, that's a pretty far move. That's about 8 points to pull back to that ADMA. And as you see, when it's very strong, even during those very strong trends, it likes to stay relatively close to that ADMA. Okay, so this is a very extended move. When you see stuff like that, you don't really want to be sorry, let me find my spot again. Here we go. You don't really want to be a seller down there, okay? So yes, this is a very strong downtrend. We don't really want to be a seller when we're that far away from the 80 EMA. What I like to say is when you're that extended, it likes to wait for it to catch up. It likes to either go sideways and let that moving average kind of slowly catch up, or it likes to sharply bounce back into that moving average. Okay, so we see that price is very bearish. It's holding below that 80 EMA. It's not allowing price to retest the 24. That's the passive line, right? The pullback traders. But it gets extended. So we want to see either a consolidation for price to come back into that short-term moving average, or we want to see a sharp bounce into that moving average. Now, typically, if it does give you one of those bear flagging patterns where you kind of slowly bounce back into the opposite direction of the trend, so the trend would be bearish here. So if we're slowly bouncing in the opposite direction, that would be bullish. If we slowly bounce back up, it is typically going to return to the 24 EMA because once again, that's where those passive traders are resting their orders. Okay, so if it's a sharp bounce, kind of like this right here, then it can return to the 80 EMA and then continue to fail. If it's a slow bounce like this one, it will typically return to the 24 EMA. An easy way to remember that is a fast bounce wants to go to the fast EMA. A slow bounce wants to go to the slow EMA. Okay? Let me see if we have any other good examples here. So here's another example of a trend that looks very aggressive, but it's actually decently passive because they were allowing price to pull back into the 24 EMA. Okay, so if we were trading that, like I said, I don't like to really use these for entries. I like to use them as confluence for my other entries. So let's say we took this as a sweeping pattern, which is another video that we just released. Let's say we took this as a sweeping pattern and we longed somewhere like this. When I start to see price respecting these moving averages, I am safe to hold on to my trade. So I can use that 24 as kind of a slow trail. If you are really itching to get out of your trade, maybe you have a lot of profit, or maybe you're just seeing things that you don't really like anymore, you can use the fast moving average as a much faster trail. But understand that the 80 EMA is tested pretty often. So if you're using that as a trail, you are really looking to get out of that trade. You are probably going to get taken out of that trade rather quickly. Okay, let's look at this on a few other time frames here because this can be used on many time frames. So let's take a look at it on the 30 minute. So same thing on the 30 minute. When the trend is very aggressive, it wants to stay below that fast moving average. If it's allowing price to pull back to the 24, the slower average, then it's more of a responsive trend. Okay, this entire trend down, this is an extremely aggressive move because they only allowed it to touch that 24 EMA one time until they finally started to find a bottom there on that inverse head and shoulders. Okay, so the amount of times you test that 24 will typically tell you how strong that overall trend is. And this is a good example of a very strong trend starting to weaken because it's starting to break through that 24 EMA. When you start to see that, you need to understand that your market structure may possibly be shifting. If you were staying below that aggressive average, that 80 EMA the entire time, and now we are starting to break that 24 EMA, you might want to take a look at the higher time frame market structure because we might be testing that market structure. We might be shifting from a downtrend to possibly back into an uptrend. Or it might be doing what we said earlier. It might just need to cool off and bounce back for a little bit before going lower. But just understand that that 24 EMA being tested typically indicates that there is a want to change that market structure. Okay. Let's take a look at this on the daily. So on the daily, we can see it basically doing the same exact thing on ES. When it's in a very aggressive trend, it stays above that 8. When it's in more of a passive trend, kind of like this one right here, it allows many more tests of that 24. And when that 24 starts to really be broken, like I just said earlier, it wants to see a market structure shift. So they try to shift that market structure. And then it goes back into respecting the ADMA again. The aggressive traders take over that trend yet again. Okay? But all right, guys, that's just a few techniques that I like to use in my scalping with the ADMA and the 24 EMA. I think these will definitely help you guys out in your trading, especially if you find yourself trading breakouts and constantly getting trapped, or you're just not being patient enough. The 24 EMA will definitely help with the patience. If you guys enjoyed this video, make sure to subscribe, hit that like button. If you guys have any questions, let me know in the comments. I'll get to them as soon as possible. See you guys in the next one. Peace.